All right, Steven. So tell me more about, I guess you work with people who've gotten mortgages and stuff like that. And in the financial planner perspective, you're talking to me about some dangers that people should watch out for.
Yes.
When getting a mortgage.
Okay.
Tell us about that.
Yeah, sure. So time and time again, we see people kind of coming into our office, whether it's from a referral, they heard about us and said, hey, we'd like to kind of chat and let's start planning some stuff. Awesome. So the first thing we're going to do is, like I said before, when we look at their income and their cash flow and their expenses, we'll say, okay, you own a house, do you have a mortgage? And when we're tying it into two cornerstones that we talked about, income protection, financial security at death, we'll kind of look at it. The mortgage actually will come up in that. Now the reason it does is often someone will go and apply for a mortgage, whether it's through a broker, at some type of financial institution or other lending institution. They'll say to them, okay, well, we need you to have some insurance. And there'll be mortgage, life insurance, and a couple other different types of insurance.
Why don't you explain those kinds of insurance and what are they?
Okay, so mortgage life insurance is something that's often embedded into your mortgage payment. And what it is the lender saying, hey Gary, I know you're going to take a whack ton of money from us, in the sum of hundreds of thousands or millions of dollars. If you die, I need to have that paid to me. Right? And that's how they kind of protect their mortgage. And also leaves it to the situation where your spouse isn't stuck getting a call saying, hey, can we have our money back?
Yeah.
One major thing to avoid is do not take the lender's insurance. Go out there and get your own life insurance.
Why? Why is that?
The first reason is you're in total control. You're the owner of the policy. And much like you have to renew your mortgage every 5 years, the same thing will come up with the insurance. Life insurance is based on your age and your health. That's how you're priced. So every 5 years that goes by, you're going to get older, which means the price is going to go up and up and up.
Okay.
Where you can lock yourself in for one time for 20 years with something very simple like term insurance. It's very inexpensive and you get a lot of coverage.
So how do lenders do it?
Lenders do it because they build it in. They'll kind of go through a quick questionnaire, and often it's not as underwritten as well as individual insurance.
Oh, okay.
So individual insurance, it is quite the book of questions, and you're going to probably get paid a visit by a nurse to come in and check you out and make sure you're okay. That doesn't happen with mortgage life insurance. It's a quick little few questions you answer. So the rate of people actually getting declined a payout on mortgage life insurance is way up here.
Oh.
Which is like, so you would pay into this thing for what? Some of the definitions, like I had one client come through and say they wouldn't insure or pay out the insurance unless he died in an accident. But what if he had cancer? What if he had a stroke? What if he had a heart attack? What if all these other things? Very vague. So why are you paying into this? More money than, sometimes 2 or 3 times more money than what individuals.
So not only is it more expensive usually,
it doesn't pay out. And in some cases, and the lending institution receives the payment, not your spouse. So say it's a husband and a wife, and the husband passes away, he's the breadwinner of that family.
Yeah.
Well, mortgage life insurance is only going to cover what's left on the mortgage, where your own life insurance would pay out your beneficiary, which in some cases is your spouse, tax-free. And now they have full control of what they're able to do with that. When owning your own personal life insurance policy, you can convert your term insurance into personal permanent insurance as well, which is often used as a tax-sheltered asset class. So it gives you that flexibility.
Okay.
And you're locked in at one price for an entire time. And every 5 years, your price is going to increase. And in a 25-year mortgage, you get your mortgage at, 35. 25 years, you're going to be 60.
Yeah.
I don't know about you, but the older you get, the more kind of trips to the doctor you got to take, and something's going to go wrong, and you don't want them to say, oh, well, because this happened, we're actually not going to insure you for that. Well, okay. Not the best situation to be in. So you want to make sure you get your own life insurance that you own, that you control, that
you get paid out.
That you get paid out on, and that's where you want to go when it comes to those things. Because because you're going to have to get it either way. I do not recommend not insuring that, because if something was going to happen, of course everyone says, oh, it's not going to happen to me. Well, guess what? It happens to all of us. We're all going to die. You want to make sure you have the appropriate protection in place from a reputable, actual insurance company, not some lending institution.
Yeah. What are the other insurance things?
So it's going to tie into...
so that's mortgage, life insurance. Don't get that from the lender.
Yeah, and then you're often going to be asked to take on other things too, and there's two of them. One is going to be disability, and the other is going to be critical illness. So if you were to become disabled, unable to work, okay, they would then pay your mortgage payment, or sometimes they would pay the interest only just to kind of protect things there. Same thing too if you were to get a critical illness. The issue there is, what is their definition of disability in the
So it's not clear, it's all vague.
It'll probably be outlined in there, but it'll say total disability. Well, much like the disability definition on your group benefits, if you're an employee somewhere and you have group benefits, you want something that's going to say, okay, if I was disabled, and you get your own disability insurance policy, a private one. If I was disabled and unable to, because of my disability, to perform the functions of my job, I will be paid out tax-free reimbursement of my wages. And they give up to 2/3 of it.
Okay.
It's never going to give you 100% because there's no actual incentive to go back to work. But you're not just paying your mortgage payment, you're getting 2/3 of your income replaced. So you can not only pay your mortgage payment, but pay your utilities, pay your tax, keep food in the fridge, pay your light and electricity and heating bill, do all the things that you want to do. And it will actually pay you till the age of 65 when you retire. And if you can't perform the role of you, for example, as a realtor, but you can go out there and do other jobs as well, well, you're insured against your income as a realtor. But if you want to go pick up other income doing other things, being a, I don't know, whatever you want, you're still your disability prevents you from doing that job, you can actually get paid on both. Where,
I didn't know that.
if you were to take the mortgage insurance, it's just going to cover your mortgage, and then you're at their mercy when it comes time to claim, because it's going to be by their definition of disability, which is also every single 5 years you're going to have to renew that contract as well. So what's going to change, right? Oh, we've been paying out too much of this, so we're going to cross out and let's not add it to the next one. No, it's tough to say. Each lender is different, but in our instance, being insurance licensed, and you want to make sure that you're talking about these important financial instruments like disability insurance, critical illness insurance, or life insurance from an actual licensed professional. That has to have continuing education credits in order to keep his license active. That has to have gone through the government testing to be insurance licensed and have a practice.
Because most lenders, the person servicing you, they're not insurance specialists.
They're legally required to say, hey, take this insurance, sign here.
Okay. They have no
and they're compensated very heavily for that in some situations to incentivize them to do that. But you want to make sure that you're going to have someone that's going to be able to service your insurance program. That's going to be able to deal with reputable insurance carriers that give you quality Canadian products, right? To do that, and it ties perfectly into your financial security. So don't fall into those three traps of taking mortgage, life insurance, or the insurance for disability or critical illness that the lender gives it to you. And the reason critical illness insurance is so important is, say you were to get a heart attack or a stroke or life-threatening cancer, or there's up to 26 actual illnesses that you can cover. Okay. Those are the big three. There's ALS, no matter how many ice bucket challenges happen out there, people still get ALS. It's not listening to you. How is that going to impact your financial situation? Do you want to just be able to cover the mortgage, or is there a lot of other alarm bells going off? With your proper critical illness coverage, you'll be able to receive a lump sum benefit paid to you tax-free. And the reason people do that is to kind of buffer the gap. Like, I just had a heart attack. I don't think it's appropriate that I go back to work. Maybe that's what gave me the heart attack. I just had a stroke. I have cancer. What if I don't want to wait around for the Canadian medical system to take care of me? What if I don't want to wait 2 years to go get an MRI? I want to just head down to the States, or I want to go do private care. What if something happens to you? What if you do have a heart attack while you're on vacation? What if you're on vacation in Phoenix and you have a heart attack, or Palm Springs, and you end up in an American hospital, and not only do you leave intact with your life, but unfortunately with a huge bill. How are you going to pay for that? Those are the things that mortgage insurance is not going to pay.
Probably not.
right? So if you're gonna get the insurance, which I recommend, get your own.
Yeah.
That covers you for anything, not just one sliver of risk. Because if you're gonna capture that type of illness, or you're gonna be in that moment where you're disabled, or passing away, the actual financial implications aren't just set to your mortgage, they're set to your full life. And those that are here with you, spouse, children, business partners, key employees, whatever it is, right? So those are things to really avoid when applying for a mortgage. I know it's quick and easy to kind of rush through the paperwork, initial here, sign here, and just give my mortgage, I want my house. Take a minute, slow down, and ask the right questions, because you want to be in a situation where you're bettering your overall financial picture, not paying for products that clearly are just going to be an insulting drop in the bucket. Okay.
Thanks guys for watching my video. Please subscribe and share with your friends. Email me if you have any more questions. Thank you.